In this video, we are going to work through 3 examples where we're going to hedge FRAs using Eurodollar futures contracts. So we're going to see the relationship between FRAs and the Eurodollar futures contract. For our first example, we're going to look at the following FRA. So we've got $1 million notional. We've agreed a rate of 3.29%. It's a 90-day loan from counterparty A to counterparty B. It starts on the 18th of March 2020 on a Eurodollar deposit rate. We're in dollars, so that's going to be an actual over 360 rate. So we've got 2 counterparties, A and B, and A starts by lending money, $1 million, on the 18th of March 2020 to counterparty B. B returns that $1 million plus interest, and we can check that interest calculation. That should be 0.1 million times 0.0329 times 90 over 360. So that's $8,225 in interest. Now we can value this FRA, assuming today is the 5th of October 2018. The days until the start date is 530, and the days until the end date is 530 plus 90, or 620 days. And we know the continuously compounded rates, 2.9383 for 530 days, and 2.9940 for 620 days. We can calculate the continuously compounded forward rate. That's R2T2 minus R1T1 over T2 minus T1. So we can plug that into our formula, find the continuously compounded forward rate is 3.3220%. We need the fair FRA rate, and so we could do a rate conversion. I know the formula off the top of my head, but we could also just simply use discount factors to calculate this formula. So the fair FRA rate is 3.29%, and of course that's the rate that A agreed to lend to B. So as the strike of the FRA is the fair rate, the value of the FRA is 0. Alternatively, from A's perspective, we can plug it into our FRA formula, and we have PV is N times RK minus RF times days over 360, E to the minus R2 times days over 365. Now, this is A's perspective. We can recognize that. So A is agreed to a rate of 3.29%. If the fair rate goes up, then A has agreed too low a rate, which means they should lose money. So we've got RK minus RF. From the borrower's perspective, of course, it would be RF minus RK. And again, both the strike rate, RK, and the fair rate are 3.29%, so the value of the FRA is 0. So some heuristics here about the interest rates. Let's think about what happens when interest rates change. So if the rate for 16th of June 2020, that's the end date of this FRA. So the end date rate stays the same, but the forward Eurodollar rate increases by 10 basis points. Does counterparty A make or lose money? Well, if the fair rate goes up, then they lent at too low a rate, right? They've locked in too low a lending rate, in which case they lose money. Okay, what about if the 0 rate for the 18th of March, that's the beginning rate, increases by 10 basis points, but the forward Eurodollar rate stays the constant, then does counterparty A make or lose money? Well, the fair rate, they traded at the fair rate, so they started out with a present value of 0. Given that rate hasn't changed, the present value stays the same, so A neither makes nor loses money. So again, we can play these games. We can look at different ways of rates changing and just think about what happens. Okay, so hedging with a Eurodollar futures contract. So we have a Eurodollar futures contract. It's got $1 million notional. It's on a 90-day deposit. And let's assume there's a Eurodollar futures contract that settles on the 18th of March 2020 with a current price of 96.71. And how do we know the current price is 96.71? It's on a 90-day deposit rate, and we just figured out that the fair 90-day deposit rate is 3.29%. The Eurodollar futures contract is 100 minus the fair rate times 100. So that's 100 minus 3.29, or 96.71. If we're counterparty A, the lender, we lose money when Eurodollar rates increase, right? Because we lent at too low a rate. To hedge our exposure to Eurodollar rates, we need to make money when Eurodollar rates increase. And if rates increase, the Eurodollar futures price falls. So we need to go short. So we're going to sell the futures contract. If we were counterparty B, we would buy the futures contract. We would go long. But we're counterparty A. Let's walk through that again, right? Counterparty A, we've locked in, we've traded the FRA, we've locked in 3.29%. If rates increase, we lose money on the FRA. Why? Because we locked in too low a rate. Our hedge needs to make money when rates increase. The futures price falls when rates increase, therefore we want to be short the futures contract. So we've entered into the FRA, we've locked in that FRA with counterparty B, and we sell one futures contract. Now if the zero rate stays the same, but the forward Eurodollar rate increases by 10 basis points, we have a different effect, right? The Eurodollar position makes $250 immediately. That's 10 basis points, $25 a basis point, $250. The FRA loses $238. We can do that calculation. We simply change our rates and see what happens. We lose $238. That $238 is the present value of $250 paid in June. If we think about this, right, if we go back to our formula, if we go back to the formula, RK minus RF times a quarter, 90 over 360, times e to the minus R2T2, that formula gives us the 10 basis points, $1 million times the 10 basis points times 0.25, that's $250. But of course, it discounts it because that money's paid in June. So our net profit and loss on our entire position, counterparty A's net profit and loss on their entire position is plus 250 on the Eurodollars, minus 238 on the FRA. They've made $12. Give or take, they've pretty much made nothing. And again, the way to think about this in terms of hedging is that they have the majority of their risk was the $250 or $238 was the majority of their risk. They've substantially reduced the size of their risk. If they hadn't hedged, they would have just lost $238. So if A is a bank and it's doing these FRAs, what are they going to do? They are going to execute an FRA, hedge it, wait, execute another FRA, hedge it, wait, execute another FRA. And that's their business model, right? They lend money, they borrow money, except deposits, right? All the time. Every time they do that, they're going to go through, trade these Eurodollar contracts, and hedge their risk. Hedging their risk substantially reduces the size of the risk, substantially reduces their exposure to interest rates. They haven't reduced it to zero. As you can see, they still have this $12 left out there, but they've reduced it substantially, right? Changing it from $238 to $12 is a substantial reduction. Okay, now there are two big differences here. One, margin versus collateral. So trades can be collateralized or not. Again, borrowing and lending, one typically thinks about not being collateralized, but over-the-counter derivatives are typically collateralized. And on the Eurodollar contracts, there's margin that has to be posted. Okay, second, the cash flows don't line up, right? The futures contract is cash settled, so you collect cash flows, positive or negative, until the 18th of March 2020. The FRA has the interest paid on the 16th of June 2020. You don't have the same kind of cash flow. This second example is going to look at the Eurodollar Futures contract as an alternative to the FRA. So let's start with the same situation, an FRA on $1 million notional with an agreed rate of 3.29%, which is a 90-day loan from counterparty A to B, starting the 18th of March 2020. So on 18th of March 2020, $1 million is paid from A to B, and on 16th of June 2020, $1 million plus interest, $8,225, is paid from B back to A. Now the problem with an FRA, or the disadvantage of an FRA, is that it's an over-the-counter contract. It can be customized as much as one likes, how much money, over what days, and so on. But there might be high transaction costs when you enter, and certainly if you had high transaction costs when you enter, there's going to be a high transaction cost when you change your mind if you would decide to unwind it. Now, the FRA we've just described doesn't have any transaction costs. So the present value to both A and B is 0. So generally, counterparty A does not lend at the fair rate, but instead lends at the fair rate plus a spread. And the spread represents their profit, and that can be large. So imagine instead of 3.29%, counterparty A says, how about 4.29%? Right? That 1% represents the cost of doing business, and that profit that counterparty A, call it the bank, needs to make on this transaction to make it worthwhile. So counterparty B can look at this and go, you know what, that cost is too high. Now we should talk a little bit about what that means for the cost to be too high. So the cost, there's always a cost, right? Even if counterparty A, if this was an immediate transaction, there will always be a spread, right? Counterparty A will never lend at the fair rate to counterparty B. But the FRA is an over-the-counter contract, so imagine the spread is that 1%. So instead of 3.29, they lend at 4.29. It might be, and you would hope and expect this, that if counterparty B approached counterparty A, approached their bank and said, can I borrow money right now? That's a more standard transaction, borrowing money right now for 90 days, in which case you would expect the spread on an immediate borrowing would be less, let's say 50 basis points, 0.5%. So the FRA allows counterparty B to lock in their borrowing rate right now, starting in the future. But if they did it right now, they could lock in the borrowing rate for the next 90 days at a lower spread. This is why it's expensive, right? The difference in spreads is why it's expensive for counterparty B to enter the FRA. That difference in spreads is the high transaction cost for entering in the over-the-counter derivative contract. Okay, the Eurodollar Futures contract is a way for counterparty B to get the same exposure as entering the FRA, but not wanting to trade over the counter. So basically, this is a way for counterparty B to get the same exposure as if they had locked in the rate without actually locking in the rate. And then they wait until the start date of the FRA that they would have entered, and they borrow money at a lower spread. Now, should they go long or short the March futures contract? Let's think about their exposure. Right now, the fair rate's 3.29, and if nothing happens in the market, you would expect, give or take, that the rate at the beginning of the FRA is going to be about 3.29%. If the rate is higher, then counterparty B is going to have to pay more to borrow. So if counterparty B had entered the FRA, they make money when rates rise and they lose money when rates fall. They want the same exposure, so they want to make money when rates rise and lose when it falls, so they want to be short the Eurodollar Futures contract. Now, assume they went short one contract at 96.71. If the zero rate for 18th March stays the same, but the forward Eurodollar rate increases by 10 basis points, counterparty B makes money in their futures, right? The futures price goes from 96.71 to 96.61, goes down, and they make 10 times 25 or $250, which is about the same as they would have if they'd entered the FRA. So the point is that the Eurodollar contract makes or loses money when the rates change, when that forward rate changes. Now, at maturity on the 18th of March 2020, they will have either made money in the margin account or lost money in the margin account. If they made money in the margin account, that means that rates are higher. If they lost money, that means rates are lower. They borrow $1 million at the prevailing 90-day Eurodollar rate. Now, if the rate is higher than on the 5th of October, the profit in the margin account exactly matches the extra interest they must pay relative to having entered the FRA on the 5th of October. If the rate is lower than on the 5th of October, they'll have losses in that margin account. They will enter into an FRA at a lower rate, but of course, they've already paid that extra interest, right? That's what the losses in the margin account represents. So basically, the margin account represents the either, if the rate's higher, the additional interest they would have to pay to borrow at the prevailing rate, or if the rate is lower, it's the interest they will save because they're borrowing at the prevailing rate. And essentially, they're borrowing at the rate that was available on the 5th of October, the 3.29%. So basically, they've been able to lock in the rate using Eurodollar futures. They don't have to enter the FRA. This transaction that they're going to enter into, borrow $1 million at the prevailing 90-day rate in March, that's a more standard transaction, hopefully gives a lower transaction cost, smaller spread, and so they're able to capture the smaller spread. Okay, for a final example, let's change the FRA. We'll have a $10 million notional. We'll have an agreed rate of 3.3081 on a 180-day deposit. So 90 days is interesting, but 180 days might be more realistic. Again, starts on the same date. So on the 18th of March, 2020, counterparty A gives $10 million to counterparty B. 14th September, 180 days later, counterparty B gives it back with interest. $10,165,405. Again, 3.3081, it's actual over 360 rate. Now assume the FRA has been executed, counterparty B wants to hedge their interest rate exposure. The March Eurodollar contract starts on the right day, but actually it ends in June. It's a 90-day contract. It's a 90-day rate that underlies that contract. The June contract starts in June and ends in September. We're going to use both contracts to hedge. So we're ignoring a couple days of interest. And does counterparty B want to be long or short? So now we're looking at counterparty B's perspective. Counterparty B is borrowing money. If rates go up, they're happy. If rates go down, they're unhappy. So they want to be long the futures contract. Right? Rates up, they're borrowing money. They've locked in a borrowing rate. If rates fall, they locked in too high a rate, so they lose money on that transaction. To hedge, they want to be long so that if rates fall, they make money back. How many contracts? 10 of each. Again, the notional amount of borrowing or lending in a Eurodollar contract is essentially $1 million. We're borrowing $10 million, or counterparty B is borrowing $10 million, so we want 10 contracts. We want 10 contracts of each. And the question, we can look at this to think about the relationship and continuously compound it, and this relationship will be approximately true for actual 360 rates. So the relationship between the continuously compounded rate from 18th of March to 16th of June, and the continuously compounded rate from 16th of June to 15th September, and the continuously compounded rate from 18th of March to 15th September, this is that forward rate is R2T2 minus R1T1 over T2 minus T1 relationship. And basically, the longer rate is the average of the other two. So the 180-day rate is the average of the 90-day rate for the first 90 days and the 90-day rate for the second 90 days. The approximate relationship, if we replace continuously compounded with fair FRAs, is that the 180-day rate is the average of the two 90-day rates. Now, what that means in particular is that if a 90-day rate changes, half of our interest payment is going to change. So the FRA is traded, counterparty B has gone long 10 March and long 10 June, and the fair rate changes by 20 basis points. On the FRA, they make about $10,000. $10 million times 20 basis points times a half. On the futures contract, the total changes in the rates average 20 basis points. So one way for that to happen is they both move by 20 basis points. Loss in the futures, 2 times 20 times 25 times 10 equals $10,000. Net, they're hedged. Alternatively, one can move by 40 and the other move by 0. But then you've got that 2 times 20 at the beginning of this. And again, 40 times 25 times 10 is 10,000. Or it could be 30 and 10, or it could be whatever. And the reality is that on the futures contract, you're going to make about $10,000. Now, it's not exact because these are all approximations, but give or take, you're going to make about $10,000. And so this becomes a decent hedge. Now, Eurodollar futures contracts are liquid for 2 to 3 years. If we're borrowing or lending through an FRA for less than 2 to 3 years, or if the whole FRA matures in less than 2 to 3 years, we can hedge with what are known as chains of Eurodollar futures contracts. So the CME group quote what are called 2-year, 3-year, and 5-year Eurodollar bundles, which settle into 8, 12, or 20 consecutive Eurodollar futures contracts to make it easy to trade a whole bunch of Eurodollar contracts at the same time. And then by trading a whole bunch of Eurodollar futures contracts at the same time, we're able to hedge longer maturity interest rates than just the 90 days that any given contract is for. So through this, if we had a 1-year FRA, we would end up using 4 Eurodollar futures contracts instead of 2, 4 consecutive Eurodollar futures contracts instead of the 2 for 180 days or the 1 for 90. So it's all about lining these things up and figuring out what rate in the FRA are we exposed to and how do we kind of replicate that rate using Eurodollar futures contracts.